All right, well, thanks for turning it over. Good afternoon, everyone. My name is Chad Firsel. I'm the president and founder of a firm called Quantum Real Estate Advisors. We have offices in Chicago and Los Angeles. I've been in the net lease business for about 22 years. And it's a great honor to be hosting a terrific panel with some of my colleagues. I just thought by way of efficiency and time that all the panel participants can go around, just give a quick 1, 2, or 3 sentence overview of who you are, what you do, and then we could jump right into some questions and get the discussion going. JT, why don't you start out actually, since you have the best view of them all.
All right, sounds good. Yeah, I'm JT Thompson. I'm with ModWash. I've been in the car wash business for about 20 years. We are on the tenant side, so a little bit different than my peers on this call. So we, look at it as an opportunity for us to grow our business and use real estate as a means to do that. So glad to be on here. Thank you.
And JT, just real quick by way of background, where were you before ModWash? Have you always been on the tenant side? Or?
Well, so I came from a company called Go Car Wash out of Phoenix. We were private equity backed by a firm out of Toronto, Canada called Imperial Capital. Prior to that, I had 23 restaurants in 6 states. So I've been on the tenant side, really almost all of my career.
That's great. Thank you.
Yeah.
Brad, you want to go next?
Yeah, sure. So I'm Brad Motley. I'm one of the founding partners of Trinity Real Estate Investment Services. We're based here in Fort Worth, Texas. We're a commercial real estate investment sales brokerage, solely focused on single tenant net lease. Since our founding in 2017, we've closed $1 billion in transactions across, I'll say 38 states, named 2019 Globe Street Net Lease Firm of the Year. And we're a growing group that is heavily active in the net lease space.
Great. Nick?
Afternoon, everybody. Nick Kanich. I work at Markets and Millichap. I'm a first vice president of investments here. I focus on single tenant net lease investment sales with a focus on the Midwest. I sit here in Chicago, but I have clients all over the country. I've been doing this since 2005 when I graduated from college.
Right. Michael, last but not least.
Well, it's not really fair because I've got so much more time in the business than everybody else. Started in this business in 98, net lease business in, 88. Net lease business in 95. Did that for about 10 years. And then the world collapsed in 2008. Decided to get into just typical, normal, up and down the street, traditional brokerage. And then recently got back together with my one of my former partners who has the NEI flag in the Minneapolis market. So we've got NEI Legacy. We do traditional brokerage. It's part of our, I guess I'd call it our deal with NEI Global. We do management. And then we have a net lease side of that business that we're expanding and leveraging through the NEI Global brokerage affiliation. So they've got 375 offices, maybe 6,000 agents. So we're going to start pushing through that. And, since they're more of a, I guess I call them independent brokerages, we think we can leverage off that and have boots on the ground in several markets. Then we also have an investment side, which focuses on investing in triple net or net lease properties. We usually syndicate those by creating DSTs. In other words, we're building this pizza and then selling it off by the slice. Mm-hmm. And that is, I guess, mostly around here in the upper Midwest. And then we're focusing on no income state tax states.
Cool.
I'm getting a really bad echo, so I'm going to try to hang up on this phone version and see if I can just hear on the computer. So I apologize if I bug out here for a second.
Okay.
So Michael, hang on before you go. When I booted you, it said you can't come back in. So try it, but if you don't get anything, hit my text and I'll create a new login for you.
Yeah, I think I'm just going to get the audio off here, and that might be all I have to do.
Okay, well, while Michael deals with that, we'll start jumping in here. I want to frame our discussion around four, I guess, topics. One is just supply, demand, pricing. And there's been a bunch of different panelists that have opined accordingly on that topic, but it'd be great to hear your guys' perspective. We'll then talk about credit, what it means, what is it, some of the tenancy and terms. We do want to talk a little bit about capital, although even the panel before was talking about that. We'll touch on that and then how we see the runway moving forward in the next 12 to 24 months. And for those of you listening, we thank you for sticking around. And so let's get right into it. In terms of supply and demand, we're seeing a significant amount of transactions take place in other product types. For example, the panel before, everyone was pretty big on industrial, and we are seeing a little bit more. We are seeing more sale leaseback transactions, etc. Where do you guys see the supply side, and what is the haves? And on the supply side, what are the have-nots? Feel free to speak, product type and or whatever sector you're in. Nick, why don't you sort of kick that off, and what do you see sort of in supply, demand, and what's the lay of the land there?
Sure. I think just obviously since the world that we're living in has changed significantly over the past 8 months or so, I've seen it in 3 tiers. Kind of the essential retailers is tier 1 with pharmacy, dollar stores, medical, grocery, and convenience, kind of staying pretty consistent throughout the entire pandemic because most of those categories stayed open. And then I would say about 3-4 months in, we saw the second tier start loosening up and coming back, which would be things like QSR, automotive, and home improvement. And then there's kind of that third tier, which has yet to really come back at all, which is more experiential retail, as well as like gyms. So I'm thinking about the world and seeing it in those different tranches. And there are a few other categories that fit within those. Outside of the first one, I named all of them. And pricing has, I think, taken a little blip in the second bucket, and then the third bucket is still undefined in the pricing department. And that's still, I think that one's still going to take some time to recover once everything starts going back to normal. But by and large, we haven't seen significant adjustment in cap rates in the first bucket, minimal in the second. So we've stayed pretty busy throughout this time.
What do you think of that, Brad?
Yeah, I mean, I think he's right. If I'm kind of trying, let me kind of start by saying the majority of what we do is probably $10 million or less, right? So as opposed to the last panel doing a lot of large ticket sale leasebacks and things like that, that's not a ballpark we're playing in currently. But for being less than 10 million, as far as demand, supply, pricing going forward, starting with demand. If you kind of separate everything from the demand side separate the buyer pool into 3 buckets. So you've got the institutional buyers that some of which were really aggressive and, stepped on the gas for Q2 and Q3 and into Q4. I would expect that to continue into 2021. Some that kind of took a step back and wanted to restructure the portfolio, and I could see them, being more active in 2021. Private exchange buyers, I think that there is still, even though there was a full panel on it today, I think there's still a section of the private market that thinks that 1031s will be going away in the near term. So maybe 2021 is the opportunity to get last minute exchanges in to set up for the long term. And then private discretionary, I think there's still cheap debt, ton of cash on the sidelines. And as far as the separation of the product type, between kind of the haves and have-nots, really, I think what we saw leading up to the July 15th trade deadline was, bifurcation in the market between investment grade and kind of everything else. Where, primarily for the private buyers and also a lot of the institutional guys, investment grade credit became the most important thing, to the point, if you look at what's going on with Dollar General and where a lot of the dollar stores are trading these days, It is a sheer trade for emphasizing credit over real estate fundamentals.
Mhm.
And you saw cap rates compress on a lot of that stuff. And I think, if you look today, we look at Crexy every day for what has hit in the last 24 hours in terms of new product. There's about 40 deals a day on average, and only about a quarter of those are investment grade with varying lease terms. I think if you project that into 2021, you're going to see a lot of the same thing. You've also got a little bit of a disruption in the development cycle. Deals needing to get approved and built, and you've got retailers pulling back on expansion plans for 2021. So I think just kind of throw everything into one big bucket there. I think that you probably see a slight increase in demand in 2021, above where we are today. But I think pricing on the investment grade stuff probably compresses quite a bit, more so due to lack of supply.
So Michael, do you see similar trends in the sense that, lack of supply, current levels of demand and or more, and Brad, correct me if I'm wrong, but I don't think that's technically, I don't think it's necessarily product driven. I think each product has its nuance and its credit spectrums and ratings, et cetera. Do you see these cap rate, Econ 101, it would tell you lack of supply, increased demand, these cap rates are going to compress. Are you seeing trifurcation or bifurcation and hence the compression? And if so, are they coming from similar groups that Brad and Nick mentioned? How are you sort of seeing supply, demand, and then, touch on pricing for us too? You're on mute, by the way. Yep, there you go.
Hear me okay now?
Yeah. Mm-hmm.
I don't use Crexy every day the way they're doing that, but I get email blasts every day from probably every net lease broker in the country. And I would say that I see a lot of the same product over and over and over. So I don't know if I would wonder if you're seeing 40 new deals every day, or if it's 40 of the same deals or 40 of the 40 deals every day. And so I'd like to know that. I was actually going to ask you what you were you seeing out there in terms of actual new deals. Is it stale product, or is it new product moving out or getting repriced?
It's essentially it's a search filter of what's been posted in the last 24 hours, and Crexy is usually pretty good about filtering out things that have already been posted before. So that's what that number is based from.
Okay, so it's a true number of 40 new deals every day. So that's a lot of product, and I feel like there's a lot of product out there. So when people talk about a compression of supply, I don't know that there really is as much as a lot of people think. I think a lot of properties are getting put under contract or under letter of intent, and they disappear for a while, and then they come back. At least I see that quite a bit. We seem to be in competition on everything that we buy, and every time I'm working with a buyer to buy something, we've got to get LOI in and have short periods of due diligence or investigation, or we're going to lose those deals. So it's sort of a weird market, and I think there was a little bit of a standstill for a while when this whole pandemic thing was trying to flesh itself out. And I totally agree with your Nick, what you were saying in terms of various tranches of property out there or product out there. I called that last one maybe hybrid essential, because there's actually some properties or some tenants out there that are they're figured it out. They're figured out how to operate in a pandemic market, whether it's having, QSRs having, drive-through and pickup, order and pickup type delivery. If it's, one of our favorite deals is we did an RH, or a restoration hardware deal in the Minneapolis market, which was a little more than we usually like to bite off in terms of price wise. That was like a $25 million deal, but we have had a lot of people interested, and we sold out a lot of that equity in those slices I was telling you about, pizza slices, because they figured out how to make it work for them. They have social distancing just by the way they operate. They increase their catalog and online exposure to the marketplace. So when people were confined to their homes, they were looking at their couches and their outdoor furniture, saying, we got to get new things. And so they started to sell.
But is the RH, and sorry for interrupting, but is the RH a function of lack of product at at that price point and that's why there's attraction to that, and they're chasing a little yield. Because if we go back to sort of Nick's buckets, just to carry that theme through, I agree with him also in the sense that, I mean, you used to, in 98, you used to be able to buy Walgreens at 8.5s. Okay. Now, new Walgreens or CVS's that are 15 years plus I have seen plenty of 5 or sub 5s or mid 4s. I've seen O'Reilly's Auto Parts at 5s. I mean, I love O'Reilly's. We've sold it. I love the company. They got a great balance sheet, but that is an extremely low yield. Extremely. So
I think it's a little bit
is the R in RH is just an interesting concept because the furniture is a little bit of this taboo relative to COVID because you can't really go in the store, etc. What's driving that? Why is that RH available?
I think you raised some great points. I think it's a little bit of both. I mean, I think there's a certain amount of people that are purchasing and doing retail deals as consumers in home goods and home improvement and things of that nature because they're trying to upgrade their environment because we're spending a lot of time in it. And so people understand that because that's the life they live in. RH also appeals to appeals to a consumer and an investor that aren't really affected as much by the pandemic. They have, good fundamental financials and they can make buying decisions that are, I don't shop at RH, but I sell RH units, so RH is a high-end retailer and it appeals to people that I think are kind of pandemic proof.
So what sort of cash on cash can you give a DST investor in that deal year one?
Well, we are giving, assuming everything continues with the way we have it set up, have to put that disclaimer in there, 6%.
Okay.
Actually, then it has increases because it has.
And how much leverage will go on that deal?
It already is done. It's at approximately 65%.
Okay.
65% equity.
So moderately leveraged deal, you're throwing off a 6 pref to your investors. And if they were to go, take their $1 million and go all cash and try and buy, or whatever, $2 million and go try and buy a Starbucks or a O'Reilly's, their yield's lower. So there's traction to yield.
I was going to say the yield was better. I mean, obviously, and then they're not a rated credit tenant, but we watched their market cap go from about $3.5 billion to it was just over $8 billion the other day. So their stock price has been just being.
So and then you are getting into the credit conversation, which we'll get to in a minute, because you're peeling back the onion and looking at the operations.
But honestly, we didn't know that when we got into it. We were comfortable with the $3.5 or $4 million net worth. And I'm sorry, this isn't supposed to be an advertisement for this deal.
Yeah.
I used it for an example as I want you to think about that. I think there's certain people that kind of fit within this hybrid essential. They're not really essential, but they are kind of essential. It depends on your marketplace. And so I think they're going to carve out a place here that isn't the typical, dollar store, 7-Eleven kind of deal.
So JT, I want to loop you in here. Thanks for being patient.
Yeah, no problem. Interesting.
Have you guys sold? Have you guys sort of rounded the bases with a developer and yourselves, have any units sold? If so, are you seeing any compression in that cap rate, or cap rate staying about the same? Where's been your disposition volume?
ModWash is a little bit unique in the sense that our sister company, Hutton, does all the development. So we work directly with them. I just came from a group called Go Car Wash out of Phoenix. And so we would acquire car washes there as opposed to what we're doing here at ModWash, which is we're going in and doing ground up builds with Hutton. Over at Go, it was interesting because we had 26 locations and we had to shut down 2 during COVID. So we did actually pretty well, all things considered. There was kind of that speed bump that everybody else hit too in March and early April, but then it seemed to rebound pretty well and stayed, pretty decent. Not just for us. We looked at a lot of P&Ls because we were acquiring other companies from West Coast all the way over to the East Coast. So we were looking at a pretty diverse set of P&Ls. And, on the sale leasebacks that we were dealing with, I think we were around this a 7 cap. So, relatively new, company. We were buying existing, financials. So we had, some history there to go to kind of take out to market. And then we had a really strong financial backer. So, certainly not down into the Chick-fil-A compression, but we are seeing, and I've seen some of my peers, drop down below 6. So, it's definitely gotten heated up, especially I think since car washes did so well that, it did attract a lot of people to look at this small sector as an opportunity.
JT, why did you guys shut down some of the locations during the pandemic? What would have?
We fought it. It was the health department that would come out, and we actually had letters, from we, as part of Homeland Security, automotive was considered essential, and then that was open to interpretation by markets. And so with Go, we were in Las Vegas, Kansas City, both in Kansas and in Missouri, kind of through that whole metro area. And then we had just acquired some units down in San Antonio. And the sites that we got shut down were in Kansas, and the sheriff department just came out twice. And so we felt like at that point we were trying to hold off as long as we could. And then for those 2 units, we felt like it was just better to not try to risk a bigger group of units getting shut down by, drawing attention to it.
Interesting.
We're gonna, before we get out of this sector, I'm gonna do a little speed round with you guys, okay? And I'm just gonna go, I don't know how my screen is, but I'll call your name out. So the last 12 months, investment grade credit marketing times, Brad, increased or decreased?
The last 6 months, you said, or last 12 months?
12 months. Let's say since COVID, we're at what, 9 months already, or 8 months? So how about
I would say comparative to the rest of the market, massively decreased. Like quick, generally able to get things done quickly.
Okay. Nick?
I'd say quicker also.
Yeah, how about you, Michael?
Increased.
Times have increased on tier 1 or marketing times have decreased?
No, marketing time has decreased. They're doing
Right.
Doing these
So let me ask you guys to the contrary. For those that are have-nots, okay, let's just pick on sectors. Let's say
movie theaters,
fitness, ones that have been affected. Are they saleable? And if so, what are those times? Are those 2, 3, 4 times the amount of market time, or how do those look for you guys?
I may not be the best one to ask here. That's kind of a space we haven't really dove into too deep. I mean, just anecdotally, I feel like, similar to what Michael was saying about emails and stuff like that, you start to see a lot of the same stuff over and over again. But as far as direct involvement, I don't really have a ton of input to provide there.
Yeah. How about you, Michael?
well, I think it's going to stay on the market for a long time. I think there needs to be, a vaccine, and people need to feel comfortable about going into a location or a facility like that. I don't know if they will hang on. I mean, there's already been downgraded the credits to some of the best and biggest chains. So they may not last. We may end up with some zombie buildings.
Mm-hmm. And Nick, is some of this product that's sort of in this, for now, the have-not bucket, is it saleable? Are you having a tough time moving any of this? Is there, demand? Are there any banks? People are always searching yield. They can't always pay a six and under. And, what are you seeing there, I guess?
I've talked to a number of owners of that third tier product, and most of them, while they might want to sell it now, I don't think anybody has picked up the phone, or anybody that I picked up the phone to talk to has said, hey, I need to sell this. I need to clear the market. And unfortunately, I think, it's largely unsaleable anywhere near where I think the market should be for it right now. I haven't seen anything in recent memory that is in that third tier bucket that has cleared the market. So I think, it's definitely going to drop significantly if someone needs to sell, but thankfully for everybody that owns those assets, they've been holding on and kind of weathering the storm.
So in summation, it sort of sounds like we have some product that's unsaleable, some product you can't keep on the shelf and these cap rates are plummeting. And then there's maybe a small sector in there where it's a hybrid, whether it's the RH or, something like that.
Mhm.
So that's interesting. I guess, quick question, just in terms of pricing, JT, when you guys go to size up a land parcel, okay, and you guys need, I'm making it up, 2 acres or an acre and a half or whatever you need, have you seen land pricing come down? Has it sort of stayed, or where are you seeing sellers of these outlots?
It's been surprising. It has held extremely strong. We were hoping, so at Go, early on, we figured that there was going to be kind of what we internally called the COVID curve, right? We thought that there was going to be some correction, and some of the multiples on the acquisitions that we were going after were going to kind of recalibrate and come down. Didn't see that happen at all. On the property side, as we're going out, I'm not seeing anything at a bargain price right now, right? It's all very competitive. It's no different than what we were looking at, honestly, 12 months ago, maybe slightly increased in some areas. How that is, I just have no explanation for it, but I keep thinking something's got to give, but nothing has given.
Do you think, just in your opinion, objectively, not optimistically, how do you see land pricing in 21, 22? Do you see any change, or you just think it's going to stay?
I think it's going to hold tight. Honestly, I do. We're love to see it come down, but we're not banking on that. We're not. We're moving forward with our business, just assuming that everything's going to stay strong, and we're just trying to find the best pieces of property and not sitting on the sidelines waiting for some bargains to fall off the shelf.
Mm-hmm. So just to keep moving forward, we talked to
Chad. Can I ask JT a real quick question?
Oh, please, yeah, please.
I want to ask you something. When you go out there and expand, are you developing your own stores as self-development, or are you using merchant developers?
So right now we use Hutton, and it's just been an incredible relationship between kind of what they do and what we do. So I work directly with, there's a whole real estate team over there, and we have people literally all over the, up and down the East Coast. So it's been, a much better situation for us going out and, here at ModWash doing the, kind of ground ups and really focus on organic growth. I think with the fact that, inventory has been really tight, I think it really speaks well for our long-term opportunities here at ModWash, just because we're creating a lot of inventory in a market that's really tight on inventory. So with Hutton, this is what they do. So as an operator, I don't have to go in and create a whole department around that. I'm just kind of paired up with people on the other side of, with Hutton, which is a sister company, to be able to really just kind of, scour a lot of different markets and hit. So we've got, we'll close this year with 17 units. I think we built the first one in June, opened it up in June. We'll close 2021 with probably 42 to 43 units opened. And, by the end of 2022, my guess is we'll be, close to 70 units. So, we're just marching right along as if, nothing is changing for us.
So because it's a sister company, I don't mean to cut in, Chad, but I just want to, this is a question I ask him because I need to find out the first part first, but are you fluid in your, I don't want you to give up your trade secrets, okay?
Yeah.
Are you fluid in your terms with them as things have changed, or in the climate that we're in, or the situation we're in with COVID?
Yeah, so we've definitely, I came in, deep into COVID. So I just started here at the beginning of September. So, there's definitely some flexibility. Hutton's been really good to work with. They look at, each deal separately. We have like I said, we have a great relationship where we go through, and there's some deals where it's like we know we really want to get in there, and they've been very accommodating to try to maybe adjust some terms to get into a piece of property that is on the high side, but I think it's a piece of property that we really want. So they've been flexible to work with. So it's just been a great team. It's been a great
Thank you.
partnership.
Cool. So let's talk term, and then I want to talk credit. I guess from a pricing standpoint, if you're within what I'll call this tier one, or a product that is sought after, whether it's QSR, coffee, auto parts, convenience, etc. Those terms, one is, it seems that, a 20-year term is more rare these days. So if you could just speak to pricing difference of what you see with a 20 and a 15, if you will. And then can you guys talk a little bit about what you're seeing in your respective, teams or whatever sector you're focused in? Brett, I know you do a lot of, dollar stores, et cetera. What happens when you fall under 10 years? Are people still picking up 7 years, or is that falling off a cliff? So I'm trying to ask, how much specificity is within that box that garners premium pricing relative to term. And then, if you could talk about spreads between sort of this 10-year and under, and then, is there anything that you're seeing from a 15 to a 20, or maybe the scarcity of that longer term lease? So I guess it's a two-pronged question. Nick, you want to start out, and then we'll go to Brad?
Yeah, sure. It is rare to see, 20, I've seen some 25-year deals recently, but they're very few and far between. You see a lot of the extension deals where the tenant will do a 10-year extension, they'll do a 15-year extension or a sale lease back. And I think pricing for 15-plus-year deals, I would give that at least, a 15, maybe 25 basis point reduction in cap rate. The 20-year deals, I think that there's a nominal adjustment, but I wouldn't call it anything significant. And then, the 10 to 15-year deals, then you just step down from there. And then as you hit that 10-year mark, or, 9.5 or less, I've still been able to capture a pretty wide market on deals that are 9.5 years, call it, and marketing them as 10-year deals. But a lot of buyers are, well, let me take a step back. The buyer pool from a 10-plus year deal to a 9 or 7-year deal, I think you're probably playing with 15 to 20% of the folks that you were if you were in that larger, that higher
20% drop off. You're saying that aren't interested in.
No, you're 20% of the entire. 80%. So if you have 80% drop off, you're dealing with only 20% of the folks that you were previously.
Oh, I'm sorry. So there's an 80% drop off that say if it's not 10 and you've got 8.5, see ya. So now you're working with 2 or 3 buyers versus 10.
Exactly, and I'm not saying that the pricing is affected as much, but what I've seen is the time for it to clear the market is going to take much longer because there aren't as many folks there that are shopping for those type of deals. And the price is adjusted, I could say maybe as much as 50 basis points or so from what I've seen. And again, this is from marketing a fair amount of pharmacies recently. And they still are clearing the market. It's just, you have to find buyers that have a compelling reason to act and some sort of affinity for that property, whether it's, they're familiar with the location, they're familiar with the tenant, they're comfortable with the sales figures that they might have, or they know somebody there and they get a nice wink nudge and they're like, oh, okay, I feel good enough about this. But yeah, your buyer pool drops off significantly on those deals. And the market time is just a little bit longer, and it's a slow march to find those buyers, but I still think that you're still able to maintain pricing pretty well with those.
Brad, do you agree with some of that? Disagree? What are your thoughts?
No, I think I agree with most of it. I mean, I think there's a lot of factors that play into it. If you want to try to compare apples to apples, I think O'Reilly's a good example because O'Reilly historically had signed 20-year leases and then recently peeled back to 15. There's still some 20-year leases that got grandfathered in that maybe have 19 or 18 left now. And I think that, again, if you're gonna compare O'Reilly A over here with 15 years, O'Reilly B over here with 18 or 19, there's probably a 30 to 40 bip difference in price just on that.
Okay.
And then, as you start to kind of get between 15 and 10, really, I think what we saw a lot of leading up to, again, the July 15th deadline was there was a lot of assets that hit the market as 12, 13-year deals from exchange buyers that had bought them 2-3 years ago that have seen that, I guess, wanted to take advantage of the opportunity of cap rate compression and actually being able to, hey, I bought this as a new 15-year deal 2 or 3 years ago. I could turn around and actually make a profit on the sale, go into the next thing and figure it out from there. So I think that the 10 to 15 gap the cap rate doesn't rise as much as it had historically. I think we're going to see more of that, like I mentioned, with the development, disruption of the development cycle and things like that. As far as the, 9 to 7 or below, your buyer pool starts to drop off quite a bit. It also kind of depends on the price point. With Nick talking more so about pharmacies, typically higher price point deals where you would normally expect, financing to be involved. Financing is much tougher to get with 9 or less than 10 years of term, because even if it's a 5-year note, lender's going to want to see some level of residual value when that note gets called 5 years down the line.
Mm-hmm.
Now, for the most part, deals less than, call it 3 million, there's still a big appetite for all cash buyers because the yield is naturally higher. So yeah, I think once you hit 7 years, the cap rate starts ticking up, and then once you get below 5, it exponentially kicks up from there. And then that's where, like Nick talked about, you have to have some sort of compelling story behind it.
So it becomes less of a single tenant,
Yeah, because now you're looking at, all right, is the rent in line with market? Is there some upside if they do leave? What's the real story behind it? Is there some level of verification or backstory that would have them sticking around long term? And, assuming all those boxes get checked, well, now I also have to be compensated for taking the additional risk.
Michael?
Well, I agree with both of them. I think the only thing I would say is that first of all, between a 15 and a 20-year lease, I don't think there's as much movement on the cap rates as it's just more people that are interested in the 20-year lease. And so what happens is you just have a bigger marketplace. I think you maybe maintain your number and you don't have to come off it very much when you sell. In other words, there's not as much discounting. But I don't think there's as much of a disparity. I think it just makes it more attractive. And it's kind of the reverse of the less than 10 years. It's less attractive, so it sits on the market longer and there's a smaller buyer pool. But I think if you get into those less than 10 years or less than 7 years or 8 years, other factors come into play that really have to be taken into consideration. How good is the lease? How net was the lease? If it's an old lease with it having roof and structure in it versus a new absolute triple net lease, if it has good bumps or not good bumps or quick bumps, whether it's a rural market or an urban market, and then how good is that market demographically? Those things really come into play on the shorter term leases, because sometimes people are paying, if it's a longer term lease, it's a long-term lease that's melted down to 6 or 7 years left, they might be paying under market in that market. So it's an okay buy. So you have to kind of take all that into consideration. I think good brokers like these guys will coach their investors into that, and will make the right decision.
Yeah, thank you. All right, so just shifting over a little into credit. Pretty loaded word, and I'll start it out with something that I sort of say to my clients when a credit is shadow rated or doesn't have a rating is, I'll say credit's in the eyes of the beholder. And do you remember MCI WorldCom? And do you remember Arthur Anderson? You remember Enron? So, these were, grade A tenants. They were the fixture. I mean, no offense to Walgreens, but that credit rating really got hurt and beat up once it's sold to the Italians. And I think, you know, this credit is loaded because we have seen, especially with this last panel, just a ton of sale leasebacks. And I don't know that we're seeing the risk adjusted returns, okay, for quote unquote credit and non-credit. So before we get into, you know, this bifurcation, trifurcations, Nick would say with the cap rates, I guess let's just talk about what credit is. And how are you guys seeing the market in terms of credit? And let me just lead you to where I'm trying to get you, which is, are you seeing, you know, the buyer pool turn around and say, hey, I looked at the sales, I looked at the concept, I looked at the location, the psychographic, demographic, they're going to do great here. I know they only have, thank you, I know they only have a few minutes. I know they only have a few stores, but I love the credit. Obviously, it sort of speaks for itself when it's investment grade credit. Can you just talk a little bit as it relates to, you know, the subjective view of credit? Okay, again, that's not rated, or, you know, that might be, you know, shadow rated. And then from there, how does that contrast with the buyer pool when they are making a decision to step up, pay a lower yield into that rated credit? And, you know, any other opinions you have on sort of this risk adjusted return that I see deflating a little bit, because when you have a 5.5 cap or 5 3/4 for investment grade and a 6 3/4 to a 7 for non, I don't know, you know, maybe I'm wrong. Maybe it should be 2 points, 3 points, whatever. What are you seeing, Brett? We'll go to Brad, Nick, Michael, and then JT. I am interested in, you know, how you guys are forecasting, because you're building into unlevered yields and what that residual looks like. But sorry, Brad, why don't you?
Yeah, I mean, so I think the majority of the private market is going to still just rely on the S&P and, you know, maybe not take the time to dive as deep into, you know, a 2 or 3 unit operator on something, unless the real estate's just fantastic. And there's upside for them going, because then that creates a risk mitigating factor.
Mm-hmm.
You know, I think a couple things to remember. You know, I know this virus has been such a game changer that I think sometimes people forget about some of the things that were in play before the virus occurred, which, you know, was this whole brick and mortar versus e-commerce battle and the race to be omni-channel, right? I think that the virus has accelerated that. And now you've got, you know, there's going to be clear winners and losers coming out of this in terms of who is able to adapt quickly, meet the consumer demands. And I think that those are things that I'm kind of looking out for. And I think that those are things that, you know, people start to look more at the model and how does that look over the long term? And maybe that becomes a secondary, maybe that's another way to look at things if you just want to block out S&P credit ratings.
So give me a hypothetical, let's say, Brad, sounds like you're going to, you know, look at trends and sectors and how this sort of washout, if you will, affected the state of the industry. What's an example? What's a hypothetical that you see changing, I guess, after this?
Well, I mean, it's again, I think it's accelerating trends that were already there. The whole buy online, pick up in store, you know, the ability to adapt your site or adapt your physical retail site to meet the consumer demands and battle kind of the e-commerce guys, which, you know, the traditional e-commerce retailers too have also realized that there's a need for brick and mortar. If you look at Amazon, they probably opened, I think, more than 50 physical stores during COVID. Duluth Trading is another one that's been historically very e-commerce that added 10% store count to.
Are your buyers asking these questions though? Is you know, a mom and pop who sold a 3-unit asking that question?
If I'm like, there's a few, you know, Tractor Supply, PetSmart, things like that I think are ahead of the game in that regard. Mm-hmm. And, you know, Tractor Supply, I guess, has their credit rating. PetSmart, I guess, doesn't necessarily. But as we're pitching these deals, it goes along with the story of why this is going to be resilient over the long term, right? So absent of any, you know, BBB minus, BBB plus, whatever, the compelling story as to how they're going to survive over the long term becomes the default.
Mm-hmm. So therefore the buyer is peeling back that onion saying, yeah, oh yeah, well, pet stores, I mean, you know, the silver lining of this is the shelters in Chicago don't have any pets. Everyone's getting a dog. So therefore that buyer is sort of deducing and sharing that sort of concept and the stability of that income.
Yeah, and then there's also just the third leg of like brand familiarity, right? Like like Whataburger, for an example, is one that's big around here that people just love Whataburger. I guess it'd be the same as In-N-Out on the West Coast, to where, you know, hey, it's a good product, looks to be a good operator, privately held credit. So, you know, the backing is a little bit of a mystery, but they seem to be doing great, and I like going there. So let's go buy a Whataburger deal.
Got it. Nick, what do you think of that?
I would definitely agree with a lot of what Brad has said. I think the buyer pool that we're dealing with, and I'm similar to Brad, and where I'm not selling a lot of $10+ million deals, is high volume, lower price point. They're gravitating towards the things that they're comfortable with and that they're familiar with, and the devil's in the details when it comes to these deals, because you get a lot of buyers that look at, you know, the sales at the store. And while that's one indicator, I think that's kind of like, you know, to use an apartment term, like a gross rent multiplier is not a cap rate on an apartment building. So people look at one particular little piece of the pie and they say, okay, well, you know, the rent to sales is under 8%, so I feel comfortable. And that does not give you a good snapshot of the way that the guarantor is running their business, or the, you know, or the actual way that that particular property is running. But people want something to hang on to, and they want a brand that they're familiar with. So a lot of these tenants that might not report sales, or they have a brand, but it's a smaller guarantee, I think they are artificially being held up by the overall perception and the other data points that people can point to and say, oh, you know, that Burger King traded for a 6 cap, so mine is at a 6.25 is a great deal. And they don't get down into that. And thankfully, even today, with what happened with the pandemic, not much pricing has been adjusted, so they are still safe. So it's helpful for the sellers and the brokers and anybody that benefits from these sales, because all the pricing kind of pools with, or clusters within the same area, and people feel comfortable paying similar pricing for deals that have one very thin familiarity, like a corporate guaranteed quick service restaurant versus a 5-unit franchisee. They are going to trade close to one another if they just have the same, you know, they're both Taco Bell, which in my personal opinion is a little wild, but I'm not here to impose my own values. I'm just here to, you know, put these things on the market and educate buyers as to what the deal is about, and they make their own decisions, and they all make very similar decisions, which is consistent.
Michael, what do you think of this credit?
I think we're almost out of time, so I'll keep it really short. I agree with everything you guys have said. And I would say there's this pride of ownership thing that happens as well. And I think especially with 1031 tax deferred exchange investors that were in something else, like an apartment complex or something where they were handling that all the time, and all of a sudden they sell it and they get into something that's, you know, low impact, mailbox money, and they can drive up there and, you know, have breakfast with their friends and say, hey, I own this building. And if it's got a great brand and it's a beautiful location, and they say, you know, at the end of the day, there's always gonna be somebody that wants to be in this location. I think it goes back to fundamentals like that. And pride of ownership is something that, you know, it's a psychological thing. I don't know how to put a handle on it, but I think you see it all the time, and you're kind of saying that, you know, both of you.
Yeah. Well, JT, why don't you finish up? And then I think Todd's waving us, but you know, you're not a rated credit, and you're you know, going around building all these stores. You will be. I mean, you have 70 stores going up in the next couple of years. God bless. So, are you, you know, do you have any sort of battle wounds from this credit conversation at all?
I've got a very friendly landlord, so you know things are pretty good for me right now. And it actually works great. I think over time, you know, as we grow this, and you know the unit economics prove out, and you know we have a subscription model that really carried a lot of the car washes through the pandemic, and that proved out to be pretty well. We're really focused on that, and I think that will drive our unit economics, which will, you know, allow us to kind of keep growing. But for today, we've got a great partnership with our landlord, Hutton. Karen Hutton owns actually both companies. So it works really well for us. I'm in a very unique position.
Yeah, I'd say.
Yeah.
Todd?